Hey everybody, it's Swaminathan. Just wanted to do a quick thing on Google because Google seems to be going down more and more. So we have an iron condor. We made an adjustment this morning on the bear call side, but you can see the bull put side is weak because it's at 870 right now, and we have a short put at 850. And it's down about 4,000. I mean, we are up, what was it, $1,700, but our position is down 4,400. But now the important thing is if we can let this expire, the entire iron condor, we've got 17,600 on this position, of course. On my 40 contract position, I've got 17,600 at stake if this thing expires worthless. So I don't mind spending some of that money and trying to get this position to work out. So let's see how we do that. Let's come here to the Analyze tab. Let's look at the risk profile first. And this is what our position is. Obviously, the bear call is even at 920, 930 looks safe. But what we don't want to happen is if Google starts going down even further and then it starts hitting a short strike. So one of the things we can do, we have about 37 days left on this trade. So what I was thinking is we come down to the weeklies, which have 9 days. Okay, so now if we bought the 850 on these weeklies, this is actually a shorty because the weeklies is the one that's expiring this week, this Friday, but this one expires next Friday. So let's see what we can do. Now I've put a position here for 10 contracts. Now I've not checked that on. So we've got a positive delta, and we don't want a positive delta because Google seems like it's going down. So if we add this long put position, we're going to pay about 3,400, and we're giving it a negative delta, which is what we want. But now let's see what that does to our profile. So now whenever you add two expiries, your things are going to go a little crazy. So basically what we want to do is come down to this expiration and put 2 there. Now it shows you exactly how this would look. So basically now if you look at this, an orangish amber line right here, that is the expiry on 9/21. The red line is the expiry on 8/24, and the white line is obviously today. So we are right here, and if Google continues to go up, if Google continues to go down, our white line, this is what it's looking like. So if it goes down at some point, this entire position will show a profit. So the white line, we're giving it a nice move down. So, but the point is now, do we want to spend so much? $3.40, it's not bad. We could go $8.60 and spend $6,000, and look what that does. Now it really, it doesn't make too much of a difference. Why spend more? So, like I said, where it becomes useful to think about this is, I've got, let me first put this back to 850. I've got $17,000 at stake right here on this position. So I don't mind giving up 3,500 out of that and protecting my position. So this is what we do. This is how we protect it. Now we've protected this position. So if Google but this protection lasts only for 9 days. Remember, because this option is going to expire next Friday, not this Friday, but next Friday. So by that time, if Google continues to go down, you have to have an alternate mechanism, which we will have, because at that point we can put in another weekly or a shorty option which has about 8 or 9 days to expiry. So and we don't mind spending another 3,000 on that because we've got 17,000 at stake. So if you look at it from that angle, this investment makes sense. This is basically like buying insurance, and the premium that you pay to buy insurance is fine. That's acceptable to you. So this is perfectly acceptable. So this is the adjustment we are going to put for Google. I'm going to send out an email. Thanks. Bye. That got filled.